In this presentation, we will take a look at what should be included in gross income for income taxes. When we're considering the income line, if we think about this from an equation standpoint, we're talking about the top line. Recall that we're talking about income taxes, therefore we're going to have an income statement. The income statement traditionally will have income up top, or revenue, minus the expenses. We're here talking about the income. We're not talking about net income. That's going to be the bottom line of an income statement. The bottom line here being the taxable income, kind of like the net income. We're talking about the top line, revenue, income, the gross revenue line. Now, it's important to always keep your perspective correct when you're thinking about taxes as opposed to financial accounting. Note, when you're talking about financial accounting and you're thinking about revenue minus expenses, you want the net income usually to be as high as possible because you want to look as good as possible. So you're hoping then to put this together and have the revenue be high, the expenses be low, and the net income then to be high. For taxes, it's reversed. What we would like to do is, of course, if there's something that we can have not included in income that would be legal, we would rather not have income. We would rather have our revenue line be low. We would rather have our expenses or our deductions be high, and then the net income, this called taxable income for the tax return, to be low, because that's going to be the basis that we're going to be calculating the taxes on. So recall, anytime you think about the income taxes and financial statements, we'll be using similar tools, in this case, an income statement of one way, shape, or form, but our incentives and our natural inclinations as to which way we would like things to be going will be, in essence, the opposites. Therefore, when we're considering the income line, normally we would like income to be high because we typically want to look good. However, for taxes, we would like the income to be low. So there's going to be a lot of things that are going to be included in income, and our objective for taxes is to say, are there any items that could be a benefit, could be income to an individual that we do not have to legally put on as income on the tax return, because that will, of course, increase the taxes. And the tax code provides some benefits and has some areas where possibly there could be receipts or types of income to an individual that wouldn't be something that would be included in the taxes. Things like a 401k plan for an employer. You might be able to plan some things with an employer to have tax benefits on it, so that you're getting basically income in the form of a 401k plan in this example, but not necessarily having to pay taxes on that. How is that possible? Because it's something that you're basically not going to be including in income, even though it really is income. It is a form of compensation. So we're looking for those things that possibly we can get some form of compensation, but the things that we don't have to include legally on the income tax return. If we have to include it on the income tax return, then we're going to be thinking about, well, what types of incomes might we be able to put on the tax return and have a lower tax rate? And we have some instances where we have types of income that might be applicable to lower tax rates rather than the ordinary income tax rate. So those are the things that you want to basically consider when thinking about the income line. Now, also, when you think about the income line, note we think about it in the formula as basically one line item of income. But clearly, there's going to be a lot of things that are going to be included in that. And you would think about that similar as you would if you were to set up your Excel worksheet. If you're going to put this in an Excel worksheet, you're going to say, hey, this is my principal formula. We have the income up top, and then say, I'm going to feed all the types of income into it, possibly with another sheet. Here's another sheet where we can list our W-2 income, our interest income, our dividend income, so on and so forth, which would then feed into the first lead sheet, which will just have our income line. That's a similar fashion as to how the tax return would be set up for. So here's page 1 of the tax return. Note that the tax return doesn't just have one line item of income and all related schedules that would feed into it, but it does have some related schedules that will feed into it, and we'll talk a lot more about them later. The IRS will be clearly very concerned with the income, because they want to be able to double check the income and make sure that the income is properly being recorded as much as they can. And therefore, they're going to categorize the income a lot, and they're going to try to get second verification, basically, in the form of forms like W-2s and 1099s for that income. We'll talk more about that later. So basically everything from 1 to line 7A is going to be included in some type of income. We have wages up top in line 1. That's going to be the most common type of income. Now note that not everybody will have the interest or the dividends or the IRA distributions, pension and annuities and social securities. However, those are common enough that the IRS basically left those on the front page of the 1040, even though A lot of taxpayers may not have that. A very straightforward return may not have that, so you're going to have a lot of blank lines here. And so they could have moved it basically to another schedule. Now, other things have been moved to another schedule a long time ago because they take a lot of detail. Something like business income is going to have its own basically income statement that will be recorded on a Schedule C. So that was removed a long time ago. Other types of income items that are kind of miscellaneous have been removed or put on a new schedule in the recent changes, and those are going to be included in Section 1. So here's Schedule 1. We have more additional income lines, so we have some more items that will feed into then the tax return on the 1040. These would be presumably items that are less frequently used and therefore on a separate schedule and not on the first page of the 1040. And then again, we're going to have other kind of line items. Income is a little bit deceiving because when we think about our income line here, it's as if we have all of our income and then the expenses in our tax formula, right? We have the income line and then we have our expenses, which are deductions on the above the line deductions or Schedule 1 deductions, then the itemized deductions. It's not quite that straightforward, however, because when you think about the income line, there's some types of things such as a business or rental property, which are going to have income and expenses related to them. And that entire income and expense line will be done with another schedule. If you have something like a pass-through S corporation or something like that, then what's going to happen is you're going to have another schedule. So if you take something like a business return, a Schedule C, the Schedule C itself will have both business income and expenses. Therefore, the expenses or deductions related to the Schedule C will be reported elsewhere and then will flow into line 1 on the 1040. So this income line then with regards to business income of Schedule C will really be the net income of the Schedule C, right? It's going to be the income minus the expenses. So we'll get into businesses later. Obviously, a Schedule C is going to be a bit more complex of a return, or if there's rental property, you'll have a similar situation, bit more complex of a return in those situations. Talking about someone that just has the W-2 income, investment income, pensions, or something like that, Social Security, that's going to be pretty straightforward on the first page, and you'll usually have documentation to support that information. Now, the basic rule you want to think about with income, this is from the tax code. So this is Section 61, gross income defined. General definition, except as otherwise provided in this subtitle, gross income means all income from whatever source derived, including but not limited to the following items. So just keep that in place. Note the IRS is not defining income by saying what income is. They're basically saying it's everything unless we specifically say it's not this. It's defining it by saying it's only not income if we exclude it. It's not basically defining exactly what income is. So your default thinking then is if there's some kind of income that was received, if you found $100 on the ground, then unless the IRS specifically defines that it is not income, then that's going to be income. That's going to be the default kind of thinking that you're going to want in your head. So when you do tax preparation, the reason I point that out is because most of the time we have a lot of forms that come in, 1099s, W-2s, and so on. And a lot of tax prep, you can get in your mind, the tax preparation can get in your mind and start to say, well, if I don't have a form for it, then I don't have to report it. And well, that's not the rule. The IRS will try to double verify as much as they can because that's going to keep, more control that they can have over the process. But simply because there's not a form for it doesn't mean it's not going to be income. In fact, the default setting is that it's going to be income unless there's a specific item saying that it's not income. Now, for most basic forms of returns, we will have a second verification document. We will have the W-2s and the 1099s, and that'll be very beneficial for us to enter the information in. So the items they're listing here is the compensation. We have the gross income derived from a business, gain derived from dealings in property, interest, rents, royalties, dividends, annuities, income from life insurance and endowment contracts, pension, income from discharge of indebtedness. That's a bit of a tricky one. You discharge from indebtedness is another form of compensation. You didn't get paid, you got discharged from the indebtedness. And then we have the distributive share of partners' gross income, income in respect to decedent, and income from interest on an estate or trust.